IMF has revised the forecast of China's economic outlook. Tell us the reason of this revision.
So for this year's World Economic Outlook report, we downgraded modestly China's growth for this year and next to 6.1% this year and 5.8% next year. The slowdown in China's growth reflects mainly three factors. First is the global slowdown in investment in manufacturing. Second is the escalation of trade tensions. And third is the strengthening of financial regulations that have helped China to remain on a sustainable growth path. Well, in our view, the decline in growth, this moderate decline in growth, is appropriate for China. Our projections suggest that China's growth will slow gradually to around 5.5% by 2024. What's more important than the level of the growth, it's the quality of the growth. To what extent it's being driven by consumption versus investment? To what extent is debt being reduced and the vulnerabilities in the financial sector being addressed? Those are important, and that does require a slower pace of growth in order to sustain robust growth over the medium term.
Despite the tariff hikes, IMF still believes that China's policy stimulus is sufficient to stabilize the growth in the year ahead.
Yes, that's right. I think despite the trade tensions, we think China has policy space to respond. In this year's Article 4 consultation, our main message was for China to pursue a balanced approach centering on fiscal spending, but also allowing the exchange rate to operate freely and for other policies to continue to pursue reforms. Now, what this means in practice is that in the event that there is a more severe economic downturn, some additional policy support would be warranted. But that policy support should be contained and calibrated to the size of the shock. It should be temporary in nature, and it should be focused on rebalancing. One example of that is fiscal expansion. For example, lowering the very high Social Security contribution rates for low-paid workers and increasing spending on the social safety net, things like pension, health, education, and unemployment. Over the medium term, I think the Chinese authorities should maintain their overarching policy objective of shifting from high-speed growth to high-quality growth. That includes four things. One is to continue the de-risking and deleveraging to address financial vulnerabilities. Second is to increase the role of the private sector through further opening up the trade and investment regime. Third is to modernize the policy frameworks, things like monetary, fiscal, financial, and exchange rate, in order to help China better manage its transition during its development.
IMF welcomed the flexibility of RMB. Can you define the word flexibility?
In this year's IMF's external sector report, we assessed that China's external position in 2018 to be broadly in line with medium-term fundamentals and desirable policies. In other words, the renminbi in 2018 was neither overvalued nor undervalued. A more flexible, more market-determined exchange rate is in China's best interest because it allowed the exchange rate to serve as a shock absorber, but also give monetary policy more room to address domestic conditions. At the same time, it's in China's best interest to continue reforms to promote rebalancing and open up further its economy, because this would allow more investment into China and also to improve the efficiency with which savings and investment are used. Well, I think China in the recent years has made significant progress in allowing for greater flexibility in the exchange rate. That is, allowing the exchange rate to move up, but also down in response to market forces. Over time, I think this greater flexibility in the exchange rate is helpful because it will help develop the financial markets. It will also send the greater signal on what the direction of monetary policy is in China. So I think we very much support greater flexibility in market determination of the exchange rate.
How would you view China's contribution to the world economy in the future?
China still remains very much the main driver of global growth, accounting for nearly 40% of global growth this year. Its importance will likely increase over time. In our forecast, we project growth to gradually decline to about 5.5% by 2024. But that growth rate is well above the average for advanced economies looking ahead. So if anything, China's contribution to global growth will remain very important in the years ahead.
You visited China just a month ago. What's your main take from that trip, especially in terms of the financial opening up?
Yes, we did. We very much welcome the approach and strategy taken by the Chinese authorities to accelerate the opening up of the financial sector. I think it's beneficial for China because it helped to upgrade and modernize the financial sector. It will bring in much needed investment in technology and competition, which in turn will help Chinese corporates give them better access to credit and to new financial instruments. At the same time, it's important to upgrade the infrastructure to better manage the risks from larger capital flows. And this requires looking again at the policy frameworks for monetary, fiscal, financial, as well as a more flexible exchange rate regime.